All right, everyone. Thank you so very much for joining us for the Startup Grind event in May. We have a very exciting speaker today. At first, I'd like to introduce myself. My name is Michelle Hefner, and I work with the company CoAdvantage, right up there. We are the sponsor for Startup Grind in Austin. What we do is we help the startup community by supporting the business owners. So that way the business owners can really focus on their expertise and not have to worry about all the administrative aspects of HR and payroll, especially with benefits. And it's very important for the small business to be able to compete with larger entities. So we're able to provide all of that solution, all those resources that a large business has to a small business employer. So without further ado, I'd love to meet with all of you afterwards. If you have any questions, I can hand you my card. Happy to consult with you all. But what we're really here today for is for our interview. So I'd like to introduce Michaela.
Thank you. Hi, everyone. Thank you for being here today. We're here with Chris Pacitti with Austin Ventures. He's been with them since 1999 and serves as general partner. His investment focus is primarily on early stage technology companies in the software and internet sectors. Let's give him a big round of applause. So Chris, what is your background in?
Well, in 1992 I started a company. It was a software company, which is where I spent most of my time. It was based on a novel oxidizing chemistry, which I don't leverage much of that domain today, but after a few years, sold it to a public company, watched it crumble as a public company, which was a painful experience, but thankfully an early painful experience. And after that, I wasn't ready to re-enter the entrepreneurial world. I was a little tender from that experience. And so there was a venture firm that I had known about. This was in suburban Philadelphia, which is where I grew up. So I campaigned them for about 3 months to hire me. And then I actually worked for free for a couple months to sort of prove my worth. And then they actually did hire me. And in 1998, I convinced them to open an office in Austin. And so I moved down here to open an office for a firm called TL Ventures, joined by an entrepreneur, the guy that was the founder of a company called Tivoli. And we ran that for about 18 months, and then I got recruited over to Austin Ventures in 1999, and promoted to general partner in 2001. Focused principally on early stage technology companies, defined as, it's fairly wide aperture, but I have a mobile gaming company, I have a virtualization company, I have a automated testing company. I'm on 11 or 12 boards actually, which is a lot. So fairly wide aperture, largely early stage technology, ranges from internet-oriented business models to more enterprise software business models. Is that enough?
I think so. What shifts or recent developments are currently happening in your industry right now?
Well, there's one Austin Ventures we can talk about, but we can save that for later. My industry is sort of constantly shifting, and so that part of the challenge is to have a reasonable level of domain expertise to be able to engage, at the appropriate level in strategy and the like with startups, but be able to evolve that domain expertise, because within a fairly short period of time, you can become a dinosaur in my industry if you're not keeping up with the latest trends, be it mobility and social or whatever the trend of the week is, if you will.
What is Austin Ventures doing differently than other VCs in Austin?
Well, what we have done historically differently, we had a wide aperture of strategies within one fund, which is recently, which caused some of the changes that we've gone through. But so I was on the early stage technology side, but we also did what I would call venture consolidations. And so it's sort of a growth equity approach applied to venture markets. So HomeAway would be an example of that. Retail or Not would be an example of that, where we bought a number of companies and consolidated a sector, and that was the better strategy than just an organic strategy. Now we also have funded plenty of organic companies. But even within that fund, we do, late stage, non-tech, growth equity control transactions. And we're just talking about one before we came in here. So a fairly wide range with a reasonably tight regional focus. And so that was the thing that held us together was the regional focus. So 80% or more of that capital went to Texas, with a fairly large amount of that in Austin.
Mm-hmm. How many investments have you made to date?
Personally, I should know that answer, but I don't. It's got to be 30 or 40, maybe more. If you count seed deals, maybe it's 50. I don't know. I should learn whatever that is. But currently, I'm on the board of 12 companies.
Mm-hmm. How many deals do you look at in a year, and how many do you end up doing?
Look at seriously, not that many. Maybe 3 or 4 a week. Sort of at most. How many come in? That I look at for 5 minutes that just aren't a fit. Hundreds. And it could be not a fit for any number of reasons, either from a domain perspective, from a capital intensity perspective, regional perspective, stage and region. There's a whole bunch of criteria that qualify out an opportunity fairly quickly, but spend real time on, of that 3 or 4 that you might look at a week, you probably engage on maybe one. But, follow up, spend some time doing diligence, and in a given year, I'd say you're making a couple investments for an individual, not as a firm. As a firm, you can multiply that by, 8 or 9.
How far into business does an entrepreneur have before they can apply for funding for Austin Ventures?
Well, we've done seed deals, so that's not terribly far, but that was fairly unique. We didn't do a lot of seed investing. Because our last fund was $900 million, you kind of had to judge whether you could, put the appropriate amount of capital to work. And so usually a company would need to be, a little further along, at least have, early product market fit, maybe early, customer traction, where it could justify a, more substantial financing.
What has been the most interesting IPO or acquisition in your industry in the past year?
Well, I think the most interesting activity is really the private IPOs, I guess is what they're called, these insane valuations that you're seeing for young companies that, a $3 billion valuation for a company with, $100 million in revenue that's private. There's now more than 45 of those. And so I think that's the thing that we're all looking at and sort of scratching our head is, that trend and sort of an inversion between public market valuations and what we're seeing in upper end private market valuations. And literally there's companies that are, quality companies that have raised money at, 3x what they could go public at. So it's sort of a fascinating, we're not sure how it's all going to sort out, but it's a very interesting, development in the market. And that's really, Uber is, an obvious example, but that, to me, that's a company that probably could go public at, a sizable number. But that, at $40 billion created a fascinating trend of a whole bunch of multi-billion-dollar companies. Again, I think the number is north of 45 now, and a good portion of those, will not be able to get liquid at anything close to that price. So it's a very interesting dynamic.
Why did you choose early stage versus mid-market investments?
Well, when you have a background in entrepreneurship, you're kind of energized by working with other entrepreneurs and seeing that, it's actually, for me, it happened at a rather young age, and so the transition wasn't very difficult, but I've seen it with other successful entrepreneurs, the transition can be difficult because you're kind of going from player to coach, and that's not always easy, right? Where, you're playing a board role, and sometimes not even a board role, but so you're trying to give counsel, and that counsel isn't always listened to, and for some that's frustrating, but that's what you have to sort of get conditioned to is, try and give, the best counsel, and hopefully, a good entrepreneur isn't going to listen to everything everybody says. They can't, right? So hopefully they ingest the right things and execute on them. But I've just seen that be a difficult transition. But for me, at a fairly young age, being able to sort of come up, in the venture business, it wasn't difficult.
Mm-hmm. In your opinion, what are some of the right things entrepreneurs should be listening to regarding investments?
Well, I think among the 100 things I see, trying to grow too fast sometimes. There's this thirst to scale and grow fast, but many times if you don't, your kind of first principle needs to get the product right. Get the product right. Have happy customers, and once you really dial it in, then start to scale. What I've seen companies, really fumble is trying to sprint too fast to grow too fast, and they end up creating what we call technical debt, which is either the wrong architecture, or you've built too many custom features and functions, and then once you hit a certain level scale, you start to crumble, and so that, to me, it's a very typical mistake. Is everybody's hard charging, everybody's competitive, everybody wants to advance the company, but there's this balance between being disciplined and making sure you dial on the product right, get the pricing right, get the go-to-market strategy right, before you start to hit the gas too hard, because it seems a lot of companies, kind of blow through their early capital without accomplishing what they wanted to, or get to an interesting scale and then flatten out because they didn't get everything right in the earlier parts of the company.
How long does it usually take you to determine if it's worth investing in or not?
For me, probably a month, 4 to 6 weeks. That's pretty typical.
How involved are you in the day-to-day operations of the companies you invest in?
Not at all, and if I am, it's a problem. But really, I'm a board member, and I'm helpful on certain things, but day-to-day operations isn't what I should be helpful on. But if I am helpful in day-to-day operations, it probably means I don't have the right executives.
Do you think that's important for investors to be hands-on in the companies they invest in, or is your approach the better approach?
I think it's important to have the right management team, and I think you can be hands-on day-to-day, but how many companies can you actually do that with? And at what point do you transition to somebody that can do it full-time? And for me, having somebody full-time, accountable in the company who's signed up to run a role, that's the strategy that can grow. Having somebody in an interim basis is just a bridge to that construct.
Mm-hmm. What has been your most challenging professional experience?
Well, the business I have chosen is a humbling one. I've done it for 20 years, and you think you know everything, and then you find out you don't. And so there's always twists and turns. This is the for everyone in the room, it's the life you've signed up for. That there's certain factors you can control, and even if you do all those things I was saying to do, and get the product right, and dial in your go-to-market strategy, and scale, leveraging your first principles of having the right product. Market can change, competition can change, macroeconomic environment can change. There's always other factors you can't control. Regulatory issues, obviously competitive issues. So it's frustrating when you think you've dialed it in and done it right, and then there's a factor, an exogenous factor that changes that creates a real headwind for the company. And a lot of times it's competitive. Suddenly Google starts giving away your product for free, which has happened, right? That happened to Omniture, right? So Omniture launches and Google starts giving away its analytics product for free, and so then Omniture had to convince its customers that they didn't want Google's free product because Google would have data that you didn't want, and they actually successfully did it, believe it or not. But that it was an incredible headwind for them to overcome.
Last question before I open it up to the audience. I know this is a really invaluable time to personally ask you questions, but what does the future of Austin Ventures look like?
It's a timely question. As I explained before, we managed or have managed some large funds that had commingled strategies. And so our investors over time, even though the returns were solid, they opine for more discrete asset allocation. And what I mean by that is, we were unique in commingling early stage venture with, mid-market private equity in one fund. And for them, they're trying to communicate to their investors and say, I've given you X amount of dollars of high alpha and X amount of dollars of, consistent returns in growth equity. And so they, asked us to sort of divide up, the fund and raise two separate vehicles. And frankly, we misjudged how hard that was going to be. On the venture side, we've had fairly unfettered access to capital. And so, my average investment over time was maybe $20 million. And for some of my partners, it was maybe $30 or $40 million. And so it was sort of hard to put us into a classic early stage fund and hard for us to sign up for a classic early stage fund. And then we also had, some folks that wanted to retire, some folks that wanted to work less, some folks that wanted to, and so we went through kind of a fairly rocky transition. And so we've kind of separated into two vehicles. One I run, which is still an early stage venture approach. It's called ABX Partners. I signed my first term sheet today, so it's on the move. But really now, in this market, after having invested in here for a long time, the opportunity I see is not actually seed or Series A. I think there's a reasonable amount of capital for seed and Series A, not necessarily capital intensive Series A. I think that's actually challenging still. But in my experience, the hardest rounds were actually what I call the marginalized middle, which is at the seed and Series A, you can sell the dream, if you will. So you can put together this great presentation deck and articulate this lovely vision against a compelling market and get people to sort of buy into that vision. At the Series B or the subsequent financings, you kind of got to sell reality a little more. So how much have you executed since the Series A? And so I have financed a bunch of companies that made a ton of progress, but just haven't hit the clear momentum phase. And if you haven't hit the clear momentum phase, it can be a difficult financing. And if you're not in a white hot sector, it can also be a difficult financing. So sometimes you can be forgiven because you picked the right sector, and so people will look past less execution than they might have expected. And so in this market, and frankly in every market outside of Silicon Valley, what I see as an interesting risk-reward opportunity is, again, what I call the marginalized middle, which is you've made traction, you got real customers, but you're $2 to $5 million in revenue. And believe it or not, that's actually a difficult fundraise. And it's partly because the venture market is now fairly bifurcated. You've got a bunch of $75 to $100 million funds that are relatively new. And then you've got a whole bunch of $1 billion funds, not unlike the one that we managed, but focused largely on venture like NEA and Lightspeed and et cetera, and not a lot in the middle. If you look at how many funds that are $200 to $300 million in scale that will invest in Austin, there might be 3 of them, and they mostly focus on SaaS. And so trying to access capital that's a fundraise of $5 to $10 million is actually challenging. And so for me, that's the segment of the market that I think is interesting, again, from a sort of a risk-reward perspective, where it's a company that's figured some stuff out and really navigated to a good go-to-market model that's relatively proven, a product market fit that's relatively proven, but hasn't hit escape velocity. Most people don't know, even in the case of Bizarre Voice that I financed in its earliest phases, I also did a small Series B because and that company worked pretty well, but we hadn't hit that threshold yet to attract the right level of a Series C. And so, not a year later, we raised money at an $80 million valuation, but we were just stuck in that sort of middle phase. And so for me, I think that's the sort of interesting opportunity in town. Also, from an approach perspective, I decided to kind of do a more community approach from an investor perspective. So classically, you raise money from institutional LPs. In my new life, I decided I didn't really feel like doing that after doing it for 20 years. And I wanted to raise money from folks I thought could add value. So the capital I've raised comes from 60 different people, most of which are in Austin, but not exclusively in Austin, that all add some kind of value. So they're CEOs of very successful companies, or CEOs of exited companies that have been successful in various domains, CTOs, CMOs, a fairly wide range of very experienced executives. And the whole fundamental approach is to sort of assemble a Navy SEAL team, if you will, of experienced executives that can help both diligence and opportunity, but also help the entrepreneur post-investment. And what I've found in my 20 years at this is a fusion of a venture lens or an investment lens, which can be helpful, but an operating lens, which is different, that has the right experience and scar tissue, can actually make a more successful investment, because you get the benefit of somebody who's been through a similar domain, a similar go-to-market strategy, similar technology challenges, and that can make that exploration phase of trying to figure things out a lot easier. And also, as many of you know, being a CEO it's a really lonely job. You don't necessarily have anybody to talk to, and so a CEO who's having some struggles doesn't necessarily want to talk to the investor, right? So getting an experienced CEO who's been through similar challenges to either be an active advisor or a board member of a company in those phases, I think is really important, because it allows what are many times first-time CEOs, someone that can talk to and just have a very open, honest conversation and help them navigate what are a series of hard decisions that never stop coming.
I'm going to open up the microphone really for audience questions. So do we have any?
I was interested to hear your comment about private market valuations versus potential public market valuations. Not something you think about or hear about a lot. Who's cutting the checks that that an IPO couldn't even provide for a company that's, I guess, at $1 billion to $3 billion kind of valuation?
Yeah, I mean, you could. It was in the Wall Street Journal. I think it was the Wall Street Journal or New York Times, maybe a month or so ago. But they've named these private companies that exceed $1 billion valuation unicorns, right? And it used to be like this really rare event that a private company would get $1 billion valuation. And then, $1 billion valuation suddenly turned into a $10 billion valuation. So that suddenly was the rare event. And then, you have Uber and a couple other companies raising money at a $40 billion valuation. And so many times it's, strangely, some of the folks like Fidelity and T. Rowe and whatnot, they actually buy IPOs. They have classically bought pre-IPO companies to get better access before it goes public, so they have larger shares of the company as it goes public. So that's not new, but we've seen them show up in some of these financings. And then also it's sort of crazy pockets of money coming from different places. I mean, some would blame the low interest rates and the strong dollar, and therefore sovereign wealth money coming from Dubai to invest in this company at a crazy price. And so it's many late stage investors, and frankly it's funds there's a lot of private funds that just raise more money than they know. The challenge of a committed fund like the one we managed most recently, a $900 million fund, you've got sort of a reverse engineered math, right? A $900 million fund, you got to put $250 to work plus or minus every year, right? And so you've got a 5-year investment period, and you've got incentive to invest faster than that 5 years to raise that next fund and put more money in the ground to work. And so that's sometimes what happens in these environments where so much capital has been raised and it's trying to find winners, and so they'll park it in a company even though they know it's at a high valuation. The bet they're making is that 3 to 5 years from now that'll all sort itself out, and they won't lose their money. So some of these funds are quite tickled to make 1.5 to 2 times their money with a very low loss rate that ends up rallying to a reasonable IRR. And so they'll invest at high valuations in companies where they feel confident, either because they have a structure or just confidence in the company that they're not going to lose their money. So Uber would be an example of that. But yeah, I mean, it's in the Valley, it's a conversation that they have almost every day. Here, less so, because we just don't see that in this market.
Thanks for your presentation. I'm curious, could you just give your comments, positive or negative, on your experiences with intellectual property or patent protection and what you do?
Yeah, basically intellectual property doesn't matter much until you're in a transaction, and then it matters, right? And almost every time we're in a transaction, we get sued by somebody. So as soon as the word gets out that Dell's buying this company or IBM's buying that company, 2 lawsuits come in, which there's an escrow already set up to protect against, but it's literally as predictable as rain. And so having reasonable IP, while it doesn't really matter from an execution phase against various companies, it does in very narrow, of course this depends business to business, but just in enterprise software or internet or something like that, IP in and of itself doesn't matter that much in a daily operation cadence, but in a transaction, you'll get a better valuation for it, and then you'll be able to protect yourself from an escrow perspective if you've got some reasonable IP to sort of let the lawyers do a little battle on. And so that that has worked out. So we definitely support filing for patents and building up intellectual property, and it's 15 to 25 grand or something like that per patent if you do it somewhat efficiently. So it's not a huge drain on capital, but getting a reasonable IP portfolio in general is a good idea. And depending on the sector, it's a requirement. I mean, if you're in certain sectors, you absolutely need it.
Do you have a question? Yeah, what's a good market strategy for, or like a market potential for you that you think is interesting? Like sometimes I talk to some VCs and they're like, when I explain the market, and maybe my pure communication, is that I tell them like it's a $6 billion market, and they come back and they're like, well, if the market was a little bit more attractive to me, so what would that mean to you? When you see an investor deck, or how you make that determination, is this a good market for you to get into?
Yeah, it's a hard question necessarily to answer generically because different markets have different attractiveness. The margin profile of that $6 billion, for instance, if it's a 10% gross margin kind of business, then that's not a very interesting market. If it's a 80% gross margin kind of business, then that's an interesting market. If it's a recurring revenue business and it's $6 billion, which would be unusually large, that's a very attractive market, because that market exists every year as opposed to just a finite amount. So sometimes it's not just about market. I think the biggest challenge in the entrepreneurial land, among others, though, but among the bigger ones is you have a large market, but how does this 12-employee company go pursue a $6 billion market realistically, right? And so you have to start out with a fairly narrow segment of that market that you can dominate and sort of iterate, and that's the biggest challenge. Is some people, everybody should be interested in a $6 billion market, presuming a reasonable margin profile, but it's the interpretation of an emerging company's ability to execute into that $6 billion. How much of that can you really capture? So that the real question is, realistically, how much can this emerging company capture of that market, and how much incumbency friction exists where you can't dent that market? And so it's sort of total available market versus total served market. Total available market would imply sort of a greenfield open opportunity. So if it's a $6 billion market opportunity and there was $5 billion of revenue already in it from existing incumbents, then it looks like one with high friction. So you're going to be butting your heads against IBM or whoever and trying to capture that market. So there's a lot of sort of unpacking to get to the attractiveness of the market segment. Part of it is the friction of incumbency and how much dominance there is, and can you truly disrupt it?
There's been a kind of a general perception among the startup community in Austin for years that there isn't enough angel investments out there to fully fund as many ideas and startups as we have in Austin, which is quite a lot. Earlier you said that there seems to be more than an adequate amount. curious where you draw that conclusion from, or how do you arrive at that conclusion?
Well, part of it is, referential perspective. When I first came to town, which was in 1998, there wasn't much capital and so, and I most, certainly even through the early 2000 period, I felt like when I took a pass on a startup, that was it, because there really weren't, many alternatives. So in a relative sense, that's improved fairly dramatically. It's sort of a supply, demand thing. A lot of there's more incubators in town, right? And so, not just Capital Factory, but, DreamWorks and everybody else, right? And so the number of company formations is much larger. But for a while, there wasn't even a robust angel community, truly. And now at least I see sort of reasonable amount of angel networks. And when I see, my judgment is when I see an interesting seed stage company, in general, it gets funded. Now I don't look at a whole bunch of them, I really don't. And so I don't have the full list. The problem with some of them is it a wide enough sort of domain? There's certain profiles that'll get funded, right? Particularly like consumer apps or things that are fairly easy to digest. The things that I see that require a high level of domain expertise to really understand are more challenging. I talked to a very credible entrepreneur the other day I've known for a long time, who has a compelling idea. It's not one in my wheelhouse, but it's one that I can at least reasonably judge that it's interesting, and his background is quite relevant for it. Yet, he needs about $1.5 million to really get it off the ground. It's not a $500,000 kind of discussion, and for him it's been challenging. And so it's certainly not universal. I think it varies, based on domain and varies on capital intensity. But it's improved, somewhat massively over probably 5 to 7 years. They still have more to go, yes, but the number of companies getting formed has sort of outpaced that capital. And so that capital has really improved, but again, now there's just so many companies getting formed, and you almost never find an equilibrium.
What 3 books would you recommend for every first-time entrepreneur? What's like on the must-read list?
I suck at that question because it's like I read so many business plans and so many board decks and everything else. Like the last thing I want to read is a business book, and so I never really read a business book. And if I do the Cliff Notes version. So the honest answer is I don't read a lot of business books, unfortunately.
Chris, can you share your thoughts on the trends for investments for startups with hardware components as opposed to pure software, maybe at Austin Ventures and then in the VC community in general over the next 2-3 years?
Yeah, hardware is much harder. Because we used to invest ourselves in semiconductors, and basically what happened over time is that the other segments got a lot more capital efficient. In a relative sense, and so they could get enterprise software as an example. 10 years ago was probably 3x more capital intensive than it is today. And semiconductor companies, as an example, they consumed like the same amount of capital, right? And so the risk-reward ratio, when you thought about how much capital was required to what the return was, just became unattractive in that part of the segment. And so a lot less capital in general went into hardware. If you have a hardware component, generally I think you want it to be not fully commoditized, but some combination of off-the-shelf and some intellectual property that you add to it, because I think it's sort of difficult to attract capital because it just adds another variable into the equation, and usually the capital intensity is higher. And so what we would find in semiconductors is, you'd have $15 to $25 million in before if you had a company, because you couldn't really engage customers until you had a taped out chip, and you had all that money in once you had a taped out chip. And as soon as you did, you kind of gave it to them. They either said this isn't interesting or it is, and so it was fairly binary. It was almost like biotech investing or something, where if you passed the FDA, great. If you failed, you're out of business. So it was more binary. and the capital intensity was higher. And so I've only done one investment, which I did with Venu Shamapan at Live Oak, who was my partner that did the hardware stuff for a long time with us. And it was really, it's a business intelligence play, but there's a component to it that is hardware related. But we had to get pretty comfortable that it was known science and reasonably well packaged, that we weren't investing a lot of money into it. So I think it's challenging. It's not, to me, ultimately that will create an opportunity, right? If there's just a dearth of capital pursuing it for too long, right, someone's going to come up with some interesting innovations, and then 5 years from now you'll be in fashion on the hardware front, right? But that's the way these cycles go. Right now it's more challenging.
Seeing a lot of companies getting high valuations without revenue models. What are some of the metrics you look for, and how important is revenue to you as an investor?
For me, it's very important. So I'm not one of the guys paying high valuations for. You can work, and usually they are sort of freemium. I mean, sometimes it's consumery and like a Pinterest or something. And, I just wouldn't be the one to finance that company. I personally can't get my head around something that doesn't have, an obvious business model. There are others that have made money. I mean, you can look at Facebook and, what was the business model early in Facebook? And so a lot of times it's about consumer engagement. And, the closest thing we have in our portfolio is a company in town called Spiceworks. And they had a free product for, basically IT managers. And in the early days, our thesis was that they'd give away the free product and then be offering premium products. And the team forever resisted offering the premium product, because sometimes when you do that, it slows down adoption because people feel like the free product must suck because you're trying to force them into the premium product and whatnot. So they resisted, and ultimately they started monetizing the data. So what happened once they had more than 1 million users, HP and IBM wanted to know about the SMB space and what they had deployed and how folks were using their various software and who had an old printer and who had the old OS and whatnot. And Spiceworks actually had all that data. And so we found that you can actually sell access to that data and so they've monetized at a very high level at this point, a different business model than we originally envisioned. But we went into the investment with a thesis, and as often happens, it didn't turn out to be exactly correct, but they sort of figured it out. So this freemium model, SolarWinds has a similar freemium model here in town, although it's sort of very clear. You have a product for free for a week or two, and they convert a certain amount of them to convert over. But a lot of the companies with no clear monetization path are usually consumer internet, and you have to have this outsized, seemingly frictionless adoption, where it just looks like it's going to grow, and then people just bet that if you get to millions of users, it's going to be worth something. That's basically the bet. It's not my kind of bet, but people make money on it.
For seed investment, do you expect to have revenue, and how much? They're already.
It'd be pretty rare for a seed investment to have revenue. The most important thing for me is where are you going to go with this money, right? So what, if it's $500,000, what is the milestone that you're going to achieve? Because the difficulty is how do you get that next round, right? And so it's more about framing, a material milestone, whatever that may be, that can attract that next layer of capital, because the risk is, even if you execute, can you get financed, in that next round? And so I would say, the vast majority of seed companies do not have revenue and probably don't have line of sight on revenue. But they have to have a plan for achievement of something pretty material to make folks comfortable that they'll, because there's all these buckets of risk, right? And so how do you de-risk it to the level that somebody else will come in and pay more?
You spoke of seed investments at 500K level. When an entrepreneur had exhausted that, what kind of revenue would you like that company to be making to be interested in taking them to the next level?
Yeah, it's a really wide range depending on whatever domain they might be in. If it's a mobile gaming company, you would have a finished game and some users, and many mobile gaming companies are free and then have a mechanic to try and monetize you within the game, and so you probably want to have a lens on early adoption of that monetization. If it's a difficult intellectual property initiative, maybe just getting to a product. If there's an unknown element of science, if you will, relative to developing the product, then you want to have that unknown element of science, well characterized and finished. And so it can be a fairly wide range, but in general, you want a fairly material milestone, right? It could be beta customers. They're not even paying you, but they're trying your product. It could be a freemium, Spiceworks was just, can we get anybody to use the product, right? And so they ended up having thousands of users in their early phases, which gave you confidence that they could kind of continue to do it. And sometimes it's also based on some core metrics. Where I see companies fail is simplistic math that's hard to know. At a seed stage, you have a multivariable formula, and you don't know many of the variables, right? The hardest one to know and to judge is cost of customer acquisition and lifetime value of the customer, right? And so I've seen a lot of companies either fail or need to pivot materially because they go in with assumption of an efficiency of acquiring a customer and therefore a transaction value for that customer. And sometimes the what we call the CAC ratio, which is the cost of customer acquisition, is too high to economically scale the business. And so in those early phases, it can be proving that out. It's a very wide range of things depending on the business.
Why did you choose the Austin market?
So I guess I mentioned I started out in suburban Philadelphia, and I started out wanting to work with early stage companies which weren't in suburban Philadelphia. And so by definition, I was on a plane to Boston, to Seattle, to Silicon Valley, to Austin and other regions. And I've at least I made a bet that Austin would be a strong upcoming region as it compared to some of those other ones that we were visiting. And I didn't think it was a good idea for the firm I was then working for to open yet another office in Silicon Valley. I thought it was better to be in an emerging market. And to really be a Series A investor, you have to be close to the companies because it's, a lot of the value we've added at Austin Ventures, frankly, is the network. So we know, tons of executives here in town, and so team building is, the most difficult challenge. And so getting the right VP of engineering early on, getting that right VP of sales, helping with the marketing executive or even the CEO or what have you. I mean, that early team and the execution that team can drive, a lot of times can change those results. And so, having that network of experienced folks and knowing them enough to know where they fit and what they're good at, because everybody isn't good at everything, right? So building that network and being in a market where you could have access to that level of talent was important. And I've just made a bet that at the time, interestingly, so this is circa '98, Atlanta and Austin were kind of neck and neck as like the emerging markets. And one of my partners was saying it's going to be Atlanta, and I was campaigning for Austin, and I haven't told him to say I was right, but that was part of the debate.
How or where did you find those early team members?
Well, thankfully, when I joined Austin Ventures, that firm started in 1984, and so there was just a network. So I was able to draft off of, in the early days, my partner's network, and then after financing however many companies and going through lots of successes, lots of failures, and frankly, you learn more, when something doesn't work than you necessarily learn when it works. Particularly when it just goes. I mean, you learn when to exit, I guess. But so finding those executives that had the right scar tissue, had been through challenging moments, and sort of adding that capability to the team is sort of part of the magical formula. But it's just born of years and years and years of grinding it out. Yeah, there's just no shortcut really.
What are some of the companies in your portfolio right now?
Well, let's see. I have one in Seattle. Believe it or not, it's called Donuts, and it's an aggregator of new top-level domains. And so you may or may not know ICANN, which is the governing body over domains, which would be .com and .net. A few years ago, opened up the process because they felt like .com was saturated and you couldn't really find the name in it anymore. So you could apply for .anything. And so I backed a team that came up with kind of a neural network algorithm to predict what were the most popular new top-level domain extensions. And so we raised $100 million. I put in 30 of the 100, and we applied for 307 top-level domains. Long story short, we got a couple hundred of them. And so that's the largest owner of new top-level domains. The second largest owner of new top-level domains turned out to be Google. So Google applied for 100, and I can explain why. But it's a fascinating, interesting business that actually is very high cash flowing because there's not a lot of cost of goods to a top-level domain. So if you register a new, we sell it through GoDaddy or 99 other registrars, and we get we own the TLD, so we get a fair share of the proceeds, if you will, and it's recurring revenue. So an interesting company. I have another company in LA called SGN, which was the founders of MySpace. Started this company after it sold MySpace, and its mobile gaming company is going quite well. Got a company in New York called Complex Media that is in the video and online media business. That's gone well. Actually started here, merged it with another company on the East Coast. And I have a company in Dallas. It's in the automated testing space. And then the balance of my portfolio is here. 10 years later, I'm still on the board of Bizarre Voice trying to get off. I've got a company in town called New Comlink that's in the fintech sector, so financial technology, which is trending, if you will. So they have a point-of-sale credit marketplace that they offer. That's actually pretty interesting. Another company called Noesis is also in the fintech space. I've got a company called Nography that is sort of intellectual property business intelligence. So kind of the vertical BI sector. I've got another company called EdgeCase that has sort of a big data play in e-commerce infrastructure. So that's there's more, but.
Any other questions? When people pitch or even investor deck, you mentioned that you sometimes rule out the first 5 minutes, kind of like a resume.
Right.
People look at. So besides, it's not the right area or the right state. What else? What turns you off when you look at something? First impression.
Yeah, a lot has to do with people, right? So it kind of where I start is background and credentials of the people, and not I back mostly first on CEOs, but what did they do prior to that? A lot of times, the ones I spend more time on get referred to me by somebody, right? So I have this fairly large network of experienced and credentialed executive entrepreneurs, and if they say, hey, you should meet Steve, I'm probably going to meet Steve, right? Because somebody, Paul Tobias, who's a attorney at Wilson Sonsini, said you should meet Brett Hurt when back in 2005. So I met Brett Hurt and ended up financing him in Bizarre Voice. But so a lot of times, getting to a VC can be best done through a referral. Because I'm going to pay more attention if it comes in, either blind or from someone I don't know. I'm not going to pay a lot of attention generally, and so sometimes it's a referral source because that helps with the credibility of the. So if that entrepreneur figured out how to get to me via somebody that I know, that at least checks the first box, right? And so from there, there's a lot of criteria in sorting through, but ultimately, this is really hard, and there's just so many twists and turns that you can't predict. That just getting the right perspective, tenacity, experience, mix of optimism and yet a balanced view on things. All those things that need to line up for all to come together. So starting right idea, right time, all those usual check boxes, but it's got to be the right people to do that.
What traits do you look for in a novice CEO?
I want to see mostly I want to see what they're willing to talk about that didn't go well, and what they learned from those experiences.
It's not running a company. Just in their professional
so they're director of product marketing for whatever company, and what were the judgments they made that weren't the right judgments, and are they willing to admit that they actually made wrong judgments, and if so, what did they learn from those experiences? So I like to see people who have had some measure of success, but have had some measure of failures and challenges, right? And the learnings from those moments, because to me that's a predictor of how are they going to react when they have some challenges and some failures in the business that they're going to be running, because it's going to happen. And those that want to pretend it's not happening, or want to blame somebody else, or not take accountability or ownership, are not going to do very well. And so it's sort of really understanding some of their past experiences, and Brett Hurt as an example. The thing I liked about him is he had some success at his prior company, Metrics, and he had some challenges, right? And was really sober about some of the judgments that they had made, mistakes they would have done differently, and had reflected on that in a way that suggested he would be able to navigate the growth phase of the company.
Do you have any other questions? Right, then I have a final one. Where do you see yourself in 5 years?
Retired. I enjoy doing this. I like the new model that I've put together, which is kind of working more shoulder to shoulder with entrepreneurs, because I like working with them when they're running a company, but I also have enjoyed working with them as we're helping guide a new CEO. And so and there's just something it's a painful job at some level, because there's problems at every company. Good, bad, every company has issues, right? And my job is always to deal with all the issues, right? I don't get the calls when things are going great. That's, navigating those, that's the path to getting a great reward, and just seeing a company go from 3 employees to hundreds of employees, and something that goes from a concept to a product that's adopted by, hundreds of customers. I mean, that's invigorating, right? And so that's what I enjoy doing, and helping folks put that together. And I'm comfortable with my role in that, right? I don't, I no longer thirst to be, center stage. I'm happy to be the guy behind the scenes, helping orchestrate the script or whatever. Right? And so, I made a decision to keep working after, the transition to Boston Ventures, because, it's what I enjoy doing.
Will you be available for personal questions after this?
Sure.
All right. Well, thank you so much, Chris, for being here, and thank you everyone for coming.